subject we are going to see is management accounting. In this, we are going to see a problem in marginal costing. In marginal costing, this is a repeated 5-mark question in your university exams. This model has been asked repeated. Let us see the problem. The question first given is, from the following information, calculate BEP and PV ratio. You know that BEP is nothing but break-even point, the point where there is no profit, no loss situation. BEP can be calculated both in rupees and units, but in this sum we have to calculate BEP in rupees, and also they have asked. First of all, we can see the details given in the problem. They have given us fixed overhead of rupees 1,20,000 and variable overhead rupees 2 lakhs, direct wages rupees 1,50,000, direct material 4,10,000, sales 10 lakh. Here we have to see that usually variable cost or variable expenses will be given under one heading, but in this problem it has been given under 3 heads. For example, for calculation of variable cost, we have to take both all these 3 things: variable overhead, direct wages, and also direct material. The summation of all these things will constitute the variable cost. Okay, now let us see the problem. First, they have asked us to calculate BEP and PV ratio. For this, we have to know that for calculating BEP, we need to have PV ratio. So, first we have to calculate PV ratio. The formula for PV ratio is nothing but contribution divided by sales into 100. So first we have sales in a problem. Sales is given in a problem. So we need to calculate the contribution. So what is the formula for calculating contribution? Contribution is nothing but sales minus variable cost. Sales is already given in the problem, that is rupees 10 lakhs. In addition, we have to calculate the variable cost. As I said earlier, variable cost here it is given under 3 different headings, namely variable overhead, direct wages, direct material. We have to add all these things, that is rupees 2 lakhs, rupees 1,50,000 and plus rupees 4,10,000. If we add all these things, we will be getting 7,60,000. The sales. In addition, we have to calculate the variable cost. As I said earlier, variable cost here it is given under 3 different headings, namely variable overhead, direct wages, direct material. We have to add all these things, that is rupees 2 lakhs, rupees 1,50,000 and plus rupees 4,10,000. If we add all these things, we will be getting 7,60,000. The sales value is 10 lakhs. So 10 lakh minus 7,60,000, we will be getting rupees 2,40,000. Here we have calculated just the contribution. We are substituting this in the formula, that is contribution of 2,40,000 divided by sales value that is given in the problem, that is rupees 10 lakh into 100. So if we substitute this 2,40,000 divided by 10 lakh into 100, we will be getting 24%. This is the profit ratio. If we make a sale, we will be getting a profit volume ratio of rupees 24%. Out of the total sales value, we will be getting a profit of 24% of the sales amount. Next, here we have to calculate the BEP, break-even point. In this sum, we are going to calculate the BEP in rupees. The formula for BEP in rupees is fixed cost divided by PV ratio. So we have to have the fixed cost. Here, fixed cost is already given in the problem. In the problem, we have been given the fixed cost. Here, fixed overhead of 1,20,000. It is already given. In this formula, we have to substitute this fixed cost of 1,20,000 divided by PV ratio that we have calculated here, 24%. If we divide this 1,20,000 divided by 24 into 100, we will be getting the break-even point. The break-even point in this particular problem is rupees 5 lakh. Here, it means that the company should at least sell the goods worth value up to rupees 5 lakh. If it is more than 5 lakhs, we will be gaining a profit. If it is less than 5 lakhs, then there will be a loss to your concern. So by this we have calculated the BEP and PV ratio in this particular problem. Thank you.